The similarities between bond funds often ends with the name bond. There are significant differences between different bond funds out there. Some of them, such as those that are more traditional index aware in the Australian context, we feel face considerable challenges in the period ahead. That's because with interest rates at very low levels, with the sensitivity of interest rates, or what we call duration, being at around record levels, the risks to those funds are that if we move to a period where interest rates are moving higher, you can incur significant capital losses. However, there are different ways of investing in bonds that we advocate very strongly. We favour very strongly being highly selective in the securities you allow to come into the portfolio. We favour managing interest rate risk very carefully, focusing on yield securities that give appropriate returns for the risk, and seeking diversification through other strategies that are unrelated to the performance, for example, of corporate bonds or government bonds. We think hybrids are a very different form of investment to many traditional bonds. Hybrids are deeply subordinated, variable coupon, often with no fixed maturity in the instrument themselves. And in many respects, they often resemble more equity style exposure than a fixed income style exposure. So they have a place. We feel that the risks are often significantly higher than understood by some in the market. And as long as the returns are commensurate with those very high risks, we feel investors may consider them, but they're not a substitute for bonds, in our opinion. Direct investing in fixed income is incredibly difficult. There's only a very small subset of what is a very large market available to retail investors. And importantly, once you build a portfolio of direct fixed income investments, you need to be able to move that very quickly or hedge different exposures to manage your portfolio, which is very difficult if you're a direct investor. So absolute return bond funds, in our opinion, simply seek to do a couple of things. Number one, they seek to deliver returns that are stable, above inflation, over time to meet the needs of investors who want income. These funds typically have a lower relationship with the broader direction of interest rates. So if yields should move higher, as we believe they have a high probability of doing over the period ahead, they are less exposed to the risks of capital loss than that. And finally, these funds are not tied to the constituents of a benchmark. Most of the constituents in the traditional Australian bond benchmark we feel are highly unattractive. And so if you start with the position of not needing to own most of those constituents, you can be highly selective in what you feel is appropriate for the fund. You can position in the right securities, you can take advantage of the right investment opportunities and build that in a very intentional way for investors.